John, can you press start broadcast there? For some reason, my screen is not doing start broadcast.
The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening to you all. We're very excited to have another Let's Talk Property. As you know, I've just returned. If any of you have been following my emails, I've just returned from another trip over to America. And to be honest, we were there for, well, this time I was there for about 8 or 9 days. One of my business partners was there for another full 2 weeks. We went to New York, Atlanta, Memphis, and Orlando. As you know, I was over there in April. We did 8 cities in 11 days. So for any of you that are interested, we've got a full kind of overview where I looked at the whole country, what was happening, why I'm so excited about the American opportunity, what the risks are, what the downsides are, how you manage those risks. So tonight is not so much an overview. Tonight, what we're doing is that when I was in America now on my most recent trip, I met one of RJ's partners. Now, you guys will all remember RJ. He's my friend who has a bit of fun knocking the doors down. But the point of the matter was I met with John, and I was incredibly impressed by John, his knowledge of the market. He's been investing in American property since the age of 19. And really, I said to John when we were there, I said, would you mind if when we get back, we actually do a webinar? And, John's done many webinars. He's actually a speaker and a coach and obviously a property investor himself. And really, tonight is an open discussion. I wanted to just, get John's opinion on what's happening in the market and really for him to tell us about the different opportunities. So without further ado, I'd like to welcome John Chin. And John, thanks so much for being online to all us South Africans out here.
Thanks for having me. I'm excited about the opportunity to talk with your investors. And, we do a lot of these with attendees from all over the globe. So, my goal out of this is outside of your attendees gaining some confidence from everything that you're going to be sharing is for them to actually walk away with some tactics and tools to arm them to make money safely in U.S. So I'm excited to be here. Thanks, Scott.
No, fantastic. And just so that you guys know, John is actually supposed to be at a workshop presentation today, so he's running a bit late. So we do really appreciate you taking the time out. I think it's 9:30 in the morning. In where are you exactly? You said Phoenix.
Yep, Phoenix, Arizona.
Okay, so 9:30 in the morning there and 7 o'clock at night here. So anyway, but without further ado, I mean, let's get straight to the chase. There's lots of people online tonight. If you do have questions, please, we want to make this as interactive as possible. If John and I will be bouncing stuff back and forth, but if you've got questions, hit us with those questions because I'm sure there's no stupid question. If you've got a question, I'm sure someone else is probably thinking about it. But I've given a little bit of an introduction to John. But John, tell us a little bit about yourself. From what I understand, you've only ever been in property. From the age of 19, you pretty much said you're based in Orlando. But tell us a bit about yourself, just so the people on the webinar kind of know who they're speaking with.
Yeah, sure. Tell you a little bit about my story. It started, like you said, when I was 19. I was actually in the U.S. Air Force, serving in the military, fixing airplanes, and I wasn't actually good at it, at turning wrenches. So I didn't enjoy it, and so I ordered the, I don't know if a lot of your attendees know about it, but it was an online course. It's one of those infomercials that comes on at like 2 o'clock in the morning. I happened to catch it one night, and it was the Carlton Sheets No Money Down Investing, How to Buy Real Estate with Zero Money Out of Pocket. So I ordered this thing, and at 19, you're not really familiar with a lot of the language like amortization, adjustable rate mortgages, a lot of what a secondary mortgage market is in the U.S., and so I felt kind of intimidated by it. I go out there and get my real estate license thinking that if I go through these courses, then I can come back to this training program and actually understand it. Well, by accident, I got my real estate license, passed the test, and then one of the first properties that I sold was to a client that had 200 properties that they personally owned, and they were just buying these properties. I sold them a cash flow house, and he was impressed with me. We became really good friends, and he kind of took me under his wing. And so from the early age of 19, I was very fortunate and blessed to have attracted a mentor that could teach me from a very tactical, real-world perspective how to make money in real estate. And so ever since that time, 17 years ago, I've been focused on serving investors specifically in the United States and abroad who want income-producing properties both in the commercial and the residential arenas. and that has kind of evolved to a speaking career where I will go around, I speak for HSBC Bank and other big brands out there to their customers that want to learn about U.S. real estate, because as you know, and a lot of the attendees on this webinar are probably aware, there's a starving crowd out there that want to know more about how to make money in U.S. real estate. So the last few years specifically, since we've seen these distressed property prices, we've seen a flood of international money coming into the U.S., and there's a lot of students. I work with a lot of students that are trying to do it safely, because obviously there's a lot of intricacies and things you got to be very careful of when you're buying from 2,000 to 6,000 to 8,000 miles away, as opposed to buying in your own backyard.
And tell me, John, I mean, one of the most important things that stood out for me is that, yes, you are a speaker, but, you know, many people say that that age-old saying, those that can't do teach. From what I understand, you know, teaching is just a bit of fun on the side. I mean, property is your real game, though.
Yeah, absolutely. And it's one of my biggest property heroes is my mother. She's a 4'9", probably 100 pounds soaking wet, old salty Korean lady who cracks a beer at about 11 o'clock in the morning after she deals with her tenants, and she's a slumlord. She buys the real cheap stuff, not something that I'm a fan of, specifically for investors abroad, but I help her invest, and I personally have been investing myself since 19, both in commercial and residential.
Fantastic. Well, without further ado, I mean, I think if anyone's got any questions, fire them, but I think hopefully you can get the feel that you're not dealing with someone who's a fly-by-night and who started out yesterday morning. 17 years worth of experience. He's certainly seen the highs and lows in American property. But tell us, John, what is the mood like in America at the moment? I'm not talking from a property perspective. I'm just talking the general mood. You know, how are the average Americans at the moment? You know, we read about all the doom and gloom from over the ocean, but what is your perception?
You know, there is two different lenses that I encounter, basically two lenses that people are viewing what's happening in the U.S. If you're talking about the perspective from being on the ground here in the United States, things have kind of stabilized. Right now, there's a lot of confrontation and controversy about what's happening with our upcoming elections and so forth. You know, there's a lot of energy around our elections right now. So that's kind of, the attention's kind of shifted to, it's interesting, a lot of us rely on external solutions to fix our problems, when a lot of times those problems can be fixed proactively by taking responsibility and accountability for where we are. But I think the masses in general, and this is true for any country, the masses in general look to the government for answers and so forth. And so right now, all the attention is on politics and our presidents, and the country's kind of divided into, for the most part, two main groups, the liberals and the conservatives. And we're looking for someone to kind of get us out of this hole. But in general, the markets have stabilized. So things have kind of stabilized. Our jobless rates are going down. Consumer confidence is slowly on the rise. That's kind of the feel on the ground from a consumer's perspective. But it's interesting, American investors are so close to the trees, they can't see the forest. And so because we're so close to people who have lost their jobs and people who have had to move in with their parents, or their parents have had to move in with them, and you know, there's that very real, you know, when our market started to come out of this, starting in about 2007 at the beginning of the credit crisis, you saw very real hardships on the ground. That's what it looked like. And but you've seen a stabilization, but because we were so close to those kinds of experiences, even if they weren't direct experiences ourselves, we knew friends or relatives, we hear the horror stories. If you're on Facebook, you hear about all the pain that people go through and so forth, and a lot of that has stabilized since. But the American investor is still gun-shy a little bit, because they can't see the clear perspective from outside because we're so close to it, if that makes sense.
No, it makes perfect sense. I always say when you come at it and you haven't been directly involved, like you said, it's so much easier. You can look at an opportunity, you can look at the yields, you can understand the fundamentals, and you can say, hang on, but this really makes sense to me, you know. But just before we get into property, tell us just a little bit. I mean, you've touched on the economy and politics, and you know, the purpose of tonight's not to get into that too much, but you know, obviously you've got your elections coming up in November. I mean, I was there 2 weeks ago, and you can't switch on the TV without them talking about the politics. But just in terms of the kind of the next, I don't know, couple of months through to, you know, the next 12 to 24 months, what's your, I mean, you don't have a crystal ball but anyone else, but kind of what's your take on how you see things panning out, you know, i.e. the elections, and then, you know, how's that going to impact the economy?
Yeah, well, whatever happens with the elections is going to be a short-term thing, and, you know, unfortunately politicians are driven by polls, and so they're just going to basically cater, say whatever on TV and during their debates. They're just going to talk to the animal brain, I like to call it, of the general public. And so the elections, even though there's a lot of energy around that right now, it's really just for votes. So when we look at the bigger picture and the long term, from a long-term perspective, all the ingredients are out there for this perfect storm for real estate investing right now. If you're going to be doing it right, that's why you're seeing so much of the Wall Street money coming into our property markets right now to buy single-family homes and individual residential properties. So long-term, though, you have a sentiment that there is going to be if you've been watching what our Federal Reserve has been doing, that pretty much controls all the dials and the switches for our economy. They can't lower interest rates any more than they have. They're not going to dump much more money into the market with the quantitative easing they've done in 2008 and 9. So you're not going to see, the Federal Reserve is basically running out of ammunition to stimulate our economy. So we're going to go through this fix slowly. We have another about 3.5 million houses, distressed properties that are going to slowly seep onto the markets. But because of all the money that's been dumped into the economy from the Federal Reserve, it expanded our money supply, and you have this fear from some people that you're going to have inflation, and that's just going to create more. A lot of real estate investors look at that as a reason to hedge against inflation. So that's a good news. So from a real estate investment perspective, there's a lot of people out there that you have people that are buying gold, and then you have some people that are leaning towards real estate. The only thing I don't like about gold is gold doesn't pay us a dividend every month. It just kind of sits there. And real estate, on the other hand, you can get returns that easily outpace paper investments in the stock market.
Well, that's a perfect moment to move on. Now, just before we get into where the market is now and where it's going, John, I just want to just take a couple of minutes and just take a step back, because, I'm not sure how many people on this webinar tonight are actually aware of, we all know that there's been massive chaos in America. We all know that, no disrespect intended, but the American housing market, effectively caused the subprime crisis, which effectively caused the banks to fall over, which effectively caused the GFC, which effectively put us where we are today. But the important thing is, I'm a big believer as an investor, one needs to know what happened so that you can understand what happened, firstly to give yourself some sort of surety that it's not going to happen again, or if it is going to happen again, how do you plan for that, basically? And I think the two things that are very, very important just to explain to everyone in terms of what happened in America and why there was such a massive problem. The first one was, I know this is an old graph, but it explains very well what actually happened. The most important thing that they had in America was reckless lending. So you would have Joe Soap, they had things called ninja loans, no income, no job, no asset, and they would lend them money. I literally have had a mortgage broker tell me to my face that I said to them, how did you get a mortgage pre-2007? And he said, literally, if you breathed into a mirror and if there was mist on the mirror, you had a heartbeat, you were given a mortgage. I mean, every time we go over to America now, we're told more and more stories about the average American having 3 and 4 mortgages over the same property. I've heard about stories where, your average payment was $1,200 per month dollars, and the bank would come to you and say, well, how much do you want to pay? And you could say, well, $300 or $400, and you could pay that and put it on the back end. And what effectively happened was you created all these reset mortgages, and people, unsophisticated people, particularly people that couldn't pay it back, they would go and they'd get a mortgage, and it would be on a low fixed rate for 2 to 3 years. And they would say to the mortgage broker, well, what's going to happen when, at the end of the 2 years? You go, oh, no worries, we'll just remortgage. And at the time, the market was rising and everyone was happy, and they thought that they were protected. But what started to happen was that these reset mortgages came into play, and they started to default. And people's interest rates went from 2, 3, and 4% up to 8, 9, 10. In many instances, they doubled and tripled. And that's when they started to default on the properties. And the problem is that in America, they've got non-recourse lending. So in South Africa, you know, if I default on my property, they'll come after me for my bicycle, my girlfriend, and my dog. But in America, you can literally walk away from your mortgage, and you know, there are things like jingle mail, which is where people literally put their keys in the mail and posted it to the bank. And when the bank got all its mail, it used to jingle because they got all, you know, all the people's properties. Now, that was the first major problem. It was this lending crisis. And what tended to happen, you can see it here in the purple, but this was the residential reset mortgages. This here was actually Lehman Brothers, you know, literally going out of business, and caused a huge amount of chaos. Now, as we know, this curve has moved on. The one that one needs to look out for is the unsecuritized debt in the commercial sector, because they tended to be on longer fixes. Now, tonight we're not focusing on the commercial unless some people want to ask some questions, and John, I'm not sure if you're happy to go through that, but the focus tonight is more on the residential sector. But I just wanted to make you aware of the first problem. The second major problem that they had in America was an oversupply. Now, John has already touched on the fact that there's still about 3.5 million homes that are oversupplied, that are being held back by the banks in terms of shadow inventory, and that still need to come into the market. At the peak, and I'd be interested to know if my numbers are right or wrong, John, according to your research, but from what I've been told, at the peak, we were about 10 million homes oversupplied. And so, you know, in 2004, 1 in every 4 homes that was built was actually was standing empty, and people were buying them because of the capital growth. They were getting great. You know, it was fantastic. You could buy it. It didn't even matter if you had a tenant, because you were making so much money out of the capital growth. And that was this huge growth that we saw, you know, from kind of 2003, when George Bush said that it's very important for every American to own a home, and they were pushing, you know, putting pressure on the banks to provide the American dream to everyone. And then around 2006, 2007, the whole pack of cards started to fall. And we all know about the massive kind of dip that took place. Anywhere, they reckon across the entire country, they lost about 40%. You must understand that the market is very specific. So in an area like New York, they might, in Manhattan as an example, they might have lost nothing. Whereas in an area like Las Vegas, they might have lost 70%. But on the whole, across the whole market, about 40%. And then literally for the last couple of years, this graph has been, you know, going up and down, kind of bouncing along the bottom as the market's trying to absorb that oversupply. And that really are the two fundamental factors that people need to understand. That is what caused the crisis. So it was reckless lending, and the second thing that caused the crisis was the oversupply. But for 5 years now, they've been kind of bouncing along the bottom. John's already mentioned people, you know, they can't see the wood for the trees. In my experience, it's absolutely amazing. I believe that there's two things that have affected the Americans. First one, and John's already touched on this, is the psychology. A lot of them have lost their own properties. A lot of them have been repossessed. If they haven't, their friend has, their mother has, their auntie has, you know. John, I'd love to know what your numbers are. Maybe it's just because I hung around property people. But when I was in America on both trips, I would say it was as high as 7 or 8 people that I met out of 10 had been directly affected themselves. They might not have lost their home, but they would have lost an investment property or somewhere along the lines. Is that is that an exaggeration, or what is your opinion on that?
I would say that it would mirror kind of like the numbers you previously, if I can echo those numbers again. 1 out of 4 were in the distressed property bubble, meaning they were 60 to 90 days behind, and those will typically turn into foreclosures. In fact, that's what's making up a lot of, that's how they calculate shadow inventory, is what the banks already have that's been foreclosed, but then they're looking at properties that are coming into that funnel that are 90 days delinquent, because they tend to fall into that foreclosure status later. But yeah, there was definitely a high number. In fact, personally, even myself, people in real estate at the time, because you know when you're in the business, you're always looking for opportunities in real estate, and no one has a crystal ball, although you can kind of anticipate trends, and a lot of us reacted, or I should say adapted accordingly. But I know very few investors, very sophisticated investors, people with degrees bigger than mine, that, you know, we weren't just selling the Kool-Aid, we were drinking the Kool-Aid too. And I personally lost a house in 2006 as well. So it's not like a lot of us were even sheltered from it, but fortunately, I wasn't impacted at the personal level where it affected my family. But yeah, I've seen it too. So,
but I mean, you just hit the nail right on the head. That's exactly what I'm talking about. So the first thing is from a psychological point of view. I mean, I've met people that, you know, I say to them, but guys, the opportunity is so good right now. Why don't you get involved? And I've literally had people look me straight in the eye and go like, I'm not interested in property at all. You know, literally what's happened over the last 5 years. You know, I wouldn't be surprised if a whole generation, you know, tend to stay renters because they don't want to get involved in property. But that, I mean, that's obviously a gross generalization, but I'm just saying that's the one key factor. And the other key factor is that the banks aren't lending right now. And all the opportunities that we're going to talk about, and we're going to go into a lot more detail now with regards to, you know, where John is and stuff, but it tends to be cash because the banks aren't lending. It's very difficult. You know, it's virtually impossible for foreigners to get finance, but it's very difficult for Americans to get finance. And so even if they can get over that psychological barrier, they still battle to get financing in terms of where they are. And in any country, including South Africa, you know, the really good deals on the auctions and everything are the guys running around with the cash can really take advantage of the opportunity. If you've got to go out and get a mortgage and it takes time and the banks are difficult to lend, you know, it's very difficult to pick up the opportunities. And that's, I just wanted to kind of summarize what John was saying in terms of a lot of Americans are stuck, you know, they can't see the wood for the trees. They're stuck in it. They're in, I always say to people, like they're in the war zone, they're in the firefight. And the advantage we have is from the outside, we can just look at the fundamentals, we can look at the opportunities, we can look at the direct investments and the type of potential returns, and it allows us to have a much more, you know, what's the word called, less emotional approach to the whole thing. But I think that gives you, you know, a basic overview. If anyone's got any questions, I can see someone's raised their hand here. Let me just, let me see who it is.
Scott, while you're looking at that question, if I can add to this, it's interesting. Warren Buffett, if you follow Warren Buffett, Wall Street mogul, one of the richest men in the United States, has a lot of credibility. He has a famous saying, the best time to invest is when there's blood in the streets, or another way to put it is when people are fearful, be greedy. When people are greedy, be fearful. And so to do what is counterintuitive, interesting, you know, I follow a lot of psychology and the way the mind works and everything, and if you look at the way the mind works, there's the old brain, or what we call the animal brain, which is part of it's the oldest part of our brain in the millions of years that we've been evolving. It's the fight or flight part of our brains. Then you have the emotional brain that came after that, and then you have now our neocortex where we have reasoning and logic and so forth. Well, the further away we operate from the amygdala, or that animal brain, which is, I'm scared, I'm going to just react. I'm scared, I'm going to react. The further away we can operate from that and use our neocortex, step away from the situation, look in on it, and make decisions, like you say, objectively, the smarter we're going to be. And that's how every successful person has done in the past. If you follow the masses, you do what the herd's doing, then you're typically doing the wrong thing when it comes to investing. And that's in stocks and in houses. A perfect example was if you were here in the United States, and you got to remember, we grow up in this country not like Israelis do, where you have enemies on every single border and you're constantly on your toes. We grow up in this country lazy, and I don't mean like that. I mean like we are not afraid of anything. Our children don't know what it's like to be afraid of anything or have any major geopolitical fears. And in that kind of environment, when 9/11 happened, it really shook our worlds up, and our markets took a dump. And my mother-in-law at the time was so beside herself because all these people that were close to retirement ages or in retirement saw their portfolios just get smacked. And she's showing me her portfolio, and I was saying, Barbara, don't pull your money out. This is the time that you need to keep buying. Dollar cost average, keep buying and buying and buying, because you're going to see this rebound. It's just a matter of time before it rebounds. Meanwhile, the public and the herd just pulling their money out. Sure enough, 2 years after 9/11 in 2001, 2 years after that, the markets were exactly where they were when that occurrence had happened. So if you were to be objective, you weren't reacting with your animal brain, and you were just looking at the situation, you know that the general masses react, and you don't play to that same reaction, then you can come out making a lot of money from those opportunities. And that's where we are right now. Same thing.
Well, I think that's a fantastic place to move on from, because my perception was when I was there in April, and I met with a number of different people, from Wall Street bankers in New York to Dr. Dolph DeRoos to property experts all around the country. And the perception was that the market had definitely reached the bottom. I went back 3 months later. I was actually with John. John and I stood next to each other, at the auctions in Atlanta, and John told me that there were 30% more people there this month than there were last month, and there were 30% more people the month before. You know, I think it was in March or April when Warren Buffett himself actually came out and said, you know, buying single-family homes in America now is one of the greatest opportunities there is. And if he could find a reliable partner to do the management and maintenance, he would buy a couple of $100,000 himself. You know, so certainly from my perception, and this is my gut feel, but not just my gut feel. It's all the reading and the research and the economists and pretty much Warren Buffett and anyone else you talk to. Donald Trump has come out and said the same thing as a matter of interest, but he's got more of a vested interest than Warren Buffett. But I believe the bottom of the market has been reached. Unfortunately, with the bottom of the market, it's always easy to call with hindsight, but probably depending on different markets, because you know all around the country it's different. But we're probably looking somewhere towards the end of last year, beginning of this year. And I certainly can feel, even from April when I was there to now in August when I was there again, the sentiment is changing, and there's definitely an uptick. And what John is saying is that the opportunity is changing. But on that basis, John, you know, it's a massive country. You know, in South Africa, we've got about, they call them in America MSAs, Metropolitan Statistical Areas. And in South Africa, we've probably got, you know, the size of Durban or Cape Town or Johannesburg or Pretoria. We've probably got between 12 or 15. Well, in America, there's over 300. And so anyone that tells you that the American market's going up or down is actually talking rubbish, because there's no such thing as the American market. One has to be a much more specific. One has to look at different areas. And, you know, John, from your perspective, I mean, you're a guy who lives in Orlando. You travel a lot around America. You travel a lot internationally, which is quite unique for Americans. But what is happening? I mean, we don't have time to obviously go into everywhere in detail, but just give us an overview in terms of your opinion of America and kind of the different areas and some of the highs and lows and what you think, you know?
Yeah, absolutely. Probably the biggest paradigm shift that my students have and a lot of the investors that I work with have is when they are looking at America from the first time as a potential real estate investor, the only information they can use to base their decisions on and their impression of what's happening in the country is national media. And so when you're looking at the national media, you look at, like, for example, the Case-Shiller Index, the chart you put on the screen before. It gives us a very good kind of a thumbnail sketch of what's happening in the U.S. But when you're on the ground, like we were at the auctions, and we're behind teams of people. I have 2 real estate companies here in Orlando, and we're seeing offers go out. We see the difference, what's happening with the offers. We see the days on market compressing. When you're dealing with landlord price properties, I call it cash flow, ideal cash flow properties where the rents are relatively high compared to the purchase prices, you're not dealing with your luxury homes or your upper middle income properties. And that environment, that space, has a completely different personality than your middle income, upper middle income luxury homes. And the space in Orlando has a completely different personality than the space in Memphis or in Atlanta or in Phoenix or in markets in California, as an example. So to your point, everything is very local. You kind of have to take a microscope down to what you're going to be looking at because the personalities are so different depending on which sub-market you're playing in. And to your point earlier, I'm glad you brought up MSAs, Metro Statistic Areas, because 93% of our country, of the population of our country, is in an MSA, one of those over 300 MSAs you referenced. And an MSA is just a grouping of cities or towns that have some type of economic tie to each other. So the Atlanta market, for example, includes the greater Atlanta market, which is a population of 5.5 million. There is economic ties around that MSA that create that MSA. And again, 93% of our population is in an MSA. So when you do your research on properties, you don't want to make conclusions and make decisions based on national news. You want to do it based on stats and found research that you do on a specific MSA. And then even within that MSA, we're going to talk about what happens inside of submarkets, either geographic areas of the MSA or with different types of properties, because one type of property is going to react completely different than another.
And tell us a little bit, John. I mean, just you hopefully can see my Google Earth map there, because you know a lot of South Africans aren't exactly aware of where all the different places are around America. But in a nutshell, kind of you got the Northeast up here with New York. Kind of what happened with the property market here versus, the likes of Phoenix, Arizona, Las Vegas, in comparison with kind of Orlando, Florida. I'm just kind of a very brief overview, just for a couple of minutes, if you don't mind. But over the last 5 years, kind of what has been the difference, between some of these bigger areas that people have heard of, obviously, and then you got California, obviously, to the left here with San Diego and Los Angeles, etc.
Let me talk about it from two different perspectives. You have areas that have higher cost of living, higher property prices in general, and then you have area with lower cost of living and lower property prices. And then you also have areas that reacted a lot more drastically with the ups and the downs during the peak real estate season and then during our correction. And so coming to the higher cost of areas, higher cost of living areas, traditionally your Northeast and then the West Coast here are your higher cost of living areas, and then some parts of Florida. In general, what I call the South or Midwest region, which is the southeast side of the United States, that's Georgia, the Carolinas, Tennessee, Kentucky, those areas are typically your lower cost of living areas. Real estate's a little bit more affordable in those areas. And then in your Midwest there. The center part of the country and the Midwest area of the country didn't react as drastically as Florida, Phoenix, Arizona, Nevada, and California when it came to the extreme highs and then the extreme rebounds or corrections when we had our credit crisis. So if I can kind of paint a picture here, let me give you kind of a live example. In Florida, for example, in your trophy markets like Las Vegas, Phoenix, Los Angeles, a lot of markets in California, you had a lot of international global demand. And when you see the availability of money, like you were talking about earlier, the ease of financing, then in areas where you had the most global or national demand, like those trophy markets like Orlando and Las Vegas specifically, you saw the extreme version of that market crisis. So you saw more people, it just basically the credit crisis, the availability of credit just exaggerated markets that had the highest global demand. So places like Orlando and Las Vegas, for example, had the most foreclosures because that's where everybody kind of gravitated to, because everybody wants to own in those markets. Those are our trophy markets, if you will. And so you saw people borrowing 9 times their income, 10 times their income in those markets when the historic average is 3 to 3.5 times is what you can legitimately afford long term. Well, when you see people buying 9 times their income and they have to prove assets to get these loans, then obviously those are the first properties that are going to default when the market corrected and the financing wasn't there anymore. And so you saw the biggest climbs in prices in those trophy markets and you saw the biggest dips. Now, if you look in the Midwest and those affordable markets that didn't have that national demand or that global demand, then you saw a slight, a less drastic climb in prices, and then you saw a less drastic drop in prices afterwards. So that's kind of gives you, just kind of in broad brushstrokes. Hopefully that's what you were kind of asking, Scott, and I answered the question thoroughly enough. But that kind of gives you kind of broad brushstrokes, 30,000-foot view, what's happening in the different regions of the U.S.
Perfect. There's just 2 things I wanted to add there because I think they are critical. So an area like New York, Manhattan, virtually lost nothing. Like absolutely, there was didn't lose any value whatsoever. Whereas areas like Phoenix and Vegas lost anywhere between 50 and 70%. I looked at houses in Vegas in 2010 that I could buy for $80,000 that were originally $320,000. I thought it was a fantastic deal until I started asking a few taxi drivers. And they told me 5,000 people, I can't even remember if it was a week or a month, so let's just for argument's sake say it was a month, were leaving Vegas, and it was my whole concern of, well, who's going to pay my rent? And interestingly enough, I watched that property, and that same property got offered back to me a year later for $40,000. Now, if I was getting a great yield with a good tenant, would I have cared if the property had gone down slightly? No. But I would have cared if it had gone down slightly and I had no tenant. And that's quite an interesting one because up in the Rust Belt over here around Detroit, which is where they're doing all the where all the car manufacturing and everything used to be, those car industries are in massive decline. And again, don't quote me exactly on the numbers, but something like, I have been told, something like 25% of the city is actually been closed down. And unfortunately, being in the property industry, we come across a lot of clients, and a lot of clients have come to us, not our clients, just people that we're talking to, that are South Africans that have bought in Detroit, and they've been promised huge things. One of our clients got promised a 50% rental guarantee, and the tenant was in there for 1 month. They moved out, and they never had another tenant again. And so one has to be very, very careful in terms of the fundamentals of areas. If a deal looks too good to be true and you're buying it on the internet, well, in my opinion, there's a good chance you're going to get into trouble, basically, in terms of where you are. But without further ado, I mean, that's kind of just an overview of the whole market. And tonight, what I wanted to do was obviously, again, John doesn't have a crystal ball better than anyone else, but he does have the ability with 17 years worth of experience to do the research. And John, tell us, you live in Orlando, you invest in Orlando, but over the last, and I don't even know how long it is, over the last year or two or whatever it is, you've been looking at another market in America. Tell us where that market is, why that market is, and why I'm doing that. I'm going to hand over the slides to yourself.
Sure. The market we're looking at right now that all our investors are gravitating to for high growth potential, high cash flows with the least amount of risk, is Atlanta, Georgia. And I'll tell you a little bit about why we like the Atlanta, Georgia market, but in a nutshell, the reason we like it is because it has very strong economic fundamentals, and things are on the upturn. You had mentioned Detroit and a lot of the car manufacturing centers of the United States that you see a mass exodus of people moving away from. A lot of those people are ending up in markets like Atlanta because they're looking for areas where they have lower cost of living, more affordable housing, more comfortable climates to live in. And I'm going to touch on all of that in this slideshow. Now what I'm going to do here, Scott, is I'm going to pull this up on my screen, full view, but if you see that the slides aren't advancing, let me know, and then I'll have to bring it down to this view again, okay?
Cool.
Okay, so do you see that full screen, Atlanta cash flow properties?
Not yet.
Okay, let me try this. How about now? Are you able to see the Atlanta cash flow property slide on the screen?
Yeah, we can see the slide fine. It's just it's not full screen, but I can see it clearly.
Let me do this. I'll just go through the slideshow like this, because if I try to blow up full screen, for some reason the Macintosh, the MacBook Airs here don't work with GoToMeeting very well. I tried recording these once before, and everybody complained that they got stuck on one slide, so I don't want to do that to the attendees here. So I'll just advance them this way. But again, Atlanta is where we are finding the best opportunities. Now, that's fortunate and unfortunate for me. From a personal perspective, I'd love to be able to just continue working in my own backyard in Orlando, Florida. But a lot of our investors are looking for higher cash flow returns than Orlando's able to offer now, because there has been such a mass buying force coming into this market in Orlando that the property prices gone up a little bit. It's harder to find the good cash flow properties. And keep in mind that a lot of my investors are international investors. So the people on the ground, the property management team that looks after the property on behalf of the investor, that helps them maximize the return on their investment, that creates a positive experience for the investor, is just as important, if not more important, than the property is. So when I talk about Atlanta, I'm going to be talking about two different things. I'm talking about the properties themselves, the opportunity themselves, the economic reasons we're there, and I'm also going to be addressing why we like the team there, because that is just as important, if not more important, than the property itself. I always like to tell investors that I would rather have, if I'm buying in a remote location, I would rather have an average property and an average buy and great team on the ground that's taking care of it for me than a great property and just an average team. Because the last thing I want to do is have to be interrupted at dinner time to take a phone call from my property manager who's telling me that someone just moved out of my house and I got to make decisions on refreshing the paint and the carpeting, and if you can follow me on there. So again, because I'm looking at it from the lens of an international investor who wants a positive experience and a safe experience, we have to do our due diligence on that front, not just on where we can get the best properties.
John, just a quick one. John?
Yeah.
This presentation, is it the same one that you emailed me 2 days ago?
Yes, it is.
Why don't I run it off my screen, and you can just tell me when you want to move over to the next page?
Okay.
Is that cool?
Let's do that. I'll send it back over to you then.
Gotta love Apple, huh?
I know, right? It's good and it's bad. My other PC just crashed on me, and it was kind of my last crutch to leave the PC world. Now I'm fully in the Mac world, but it's coming with some. It's coming with some a little bit of a learning curve for me.
Cool. So you should be able to see your screen there now.
Okay, easy enough. So let's go to the next slide. We're going to talk about what a full circle investment solution is. A full cycle investment solution is where we take care of everything for the international investor, because it's hard enough to buy a property right, get clean title to the property, manage the rehab crews, make sure that they do the job right. If you've ever dealt with investment properties in your hometown, you know how much of a hassle that can be just to get them to finish the job and do what they say they're going to do, and then to get it in the good hands of a good property manager, and then get a tenant in there so we're making money on the property. We handle all of that from that whole spectrum, from the buy all the way to the time that the property is making money for the investor. So all of our due diligence is within that operational framework, because we have to serve the international investor and provide a positive experience for them where they're making consistent money. Next slide. Did you advance? Okay, so
Yeah, you got it?
the three considerations is when you kind of bring it on down, and I apologize if I'm being redundant or very elementary or fundamental, but I want to make sure I'm not talking over anybody's head. And sometimes even as a sophisticated investor, we lose sight of what's really important with investing. And it's threefold. It's like three legs of a stool. One leg of the stool is the research we have to do around growth potential in the future, where we're getting the most appreciation potential. The second set of research we do is around where we're getting our highest cash flows for the money that's coming out of pocket, because that's our tangible benefit now. And then our last bit of research that we're doing is we layer this on top of everything we do is, are the properties we're buying going to be in a great position so that the investor can sell it easily later for a good profit? Are they going to be able to get out of the property? What's the exit strategy? And a lot of our investors don't really consider that, the exit strategy on properties. So we do a lot of due diligence around that, and that creates safety for everybody. Next slide.
Okay.
So the Atlanta market, just to kind of say it very succinctly, as I already mentioned, that it has a very strong economic base. You have a lot of industry there. You have a lot of companies. We're going to touch on some of those companies that you'll recognize here in a second that call it its headquarters. But Mark Vintner, he's an economist with Wachovia Bank, which is now Wells Fargo. He pretty much said it most succinctly. If you're not familiar with the Atlanta market, I want you to visualize the United States and cut it in half vertically, and then cut it in half again horizontally, so you have 4 pieces of a pie. The southeast corner of that pie, that quadrant, if it was its own country, then it would be the 4th largest economy in the world, with a GDP behind the rest of the United States, behind China, and behind Japan. And the center of that country would be Atlanta, Georgia, as the business center, the entertainment center, the travel center. It's home of one of the busiest airports in the country. It's a 2-hour flight within 80% of the population of the United States. So the Atlanta market is a major hub of the Southeast United States. Next slide. The population in Atlanta is 5.5 million. That includes the greater Atlanta market. And that population growth has been on the climb, one of the fastest growing metro statistic areas in the country. So I know this table is a little bit harder to see. The numbers are small, but let me just point out 2 numbers on here. When we're looking for macro fundamentals, economic fundamentals, we're looking for 3 things. Number 1, where are people moving? Because at the end of the day, if we buy real estate where people are moving, and in this case, it's people moving from other parts of the United States. It's not migration or immigration. It's what I call in-migration, inside the United States, movement from other states to this area. We're going to talk about the why behind that, but over the last 10 years, from 2000 to 2010, Atlanta grew by 1 million people, a 24% growth in 10 years. From 2010 to 2020, it's projected to grow another 1 million at about 20% growth. And so 7 out of 10 of our tenants right now, if you were to just sit down with them, ask them where they came from, 7 out of 10 of them came from another state within the last 2 years. So we see firsthand the impact and the positive benefit of being a landlord in that city, because that's who's filling our houses and paying us our rents. Next slide. The areas of Atlanta where we're buying our houses and our investors are buying, they're being filled with tenants that work in some of the 75% of the Fortune 500 companies in the U.S. that call Atlanta its home. A lot of the brands you see on your screen, Coca-Cola, CNN, Delta Airlines, Home Depot, they call Atlanta their home. That's where they're headquartered. That's where they're based. So if you ever come to Atlanta, you want to go to the Coca-Cola Museum that's downtown. You can go to the CNN Center. Martin Luther King's birth home is here in Atlanta as well. So you get a little bit of tourism here, but the main reason that we like it is because there's a lot of jobs, there's a lot of growth. The city isn't dependent on one or two industries or one or two companies. So there's very little risk. We don't have to worry about one industry or one company going down and it causing this ripple effect across the whole city. Next. So one of the reasons that you see a lot of people moving into the country is because the cost of living is lower than the national average, 6% lower than the national average. But if you have a college degree, then you're going to be making about 13% more than the national average. So it is the, I apologize, we just had a housekeeping knock on my door again. But going back to this, so the reason for the big movement of population growth in Atlanta is because people can get a lot more for their money. If you look at the boomer generation, the baby boomers in our country, 80 million of our population with the most discretionary income, they've had the biggest economic impact on every industry they have touched. From when they were graduating high school to getting into college, we saw an impact to our university system. Then they started getting married and buying houses. We saw an impact to our real estate supply. Then in the height of the credit crisis, they were in their biggest spending years. And so now they're getting into their contracting years. And they are kind of like the big pig and a snake, if you will. But that 80 million population, there's a big concentration of them in the Northeast. And when you have a fixed income and you're approaching your retirement years, you become sensitive about what you're spending your money on. And so they're moving to markets where the cost of living is lower. And secondly, the temperatures are very comfortable for them. So there is a lot of people leaving the Northeast, moving down to the South, and they're doing it because they just want more comfortable climates and a better cost of living. So we're in front of all of that movement. So the bottom line is when you're investing, one of the rule of thumbs or the check boxes I like to always have is why not be in front of, with all the opportunity in the U.S. right now, be in front of the baby boom movement if you can.
Just interesting on that, John, a stat that I was given was that 10,000 baby boomers a day are retiring.
Yeah, it's massive. It's massive,
and that's a big number. Right? That's it's a massive number of people that are retiring every single day. Do you want me to move on?
Yes, please. So we're looking for population growth. We look for strong a wide economic base. And then the last thing we're looking at is affordable market, because one of the markets, for example, that I researched that had very high GDP per capita, is a very strong economy, and they also had, they're very high in population growth projections over the next 10 years, was Austin, Texas. But Austin, Texas doesn't meet our third criteria, which is the perfect environment for a landlord investor, which is an affordable market where the rents are high but the property prices are low, creating that perfect scenario for cash flow, good cash flow. And that's what Austin was missing. So we're looking for those three prongs, if you will, and Atlanta kind of fits the mold on all three fronts. There's two ways to measure affordability in a market, and I don't want to get too technical here, but at the end of the day, the real estate prices in a local market is always going to be dictated by how much, the ceiling of those prices will always be dictated by how much people can afford. So like I said before, in the United States, home prices on average have been about 3 to 3.5 times median income. And in Atlanta market, you have home prices that are only 2 times median income. It's the third best market in the whole country by that measurement. The only other two markets that beat Atlanta as a more affordable market by that measurement is markets around the car industry, which we're not investing in because there's no growth potential up there. We don't see it as strong as markets in the South. So that's one of the biggest drivers for us being in Atlanta. If your income is only half of what the cost of prices are, and the historic average is prices to be 3.5 times the median income, then there's a lot more house that people can afford to buy, which means that someone who's going to buy the house in 5 years from now that you bought for $100,000 can justify paying $150,000 because one reason is because they can afford that much more house. Second thing we look for in affordability is what is the rent payments compared to what the mortgage payments would be on that same property. So let's take an example, Scott. I'm painting a scenario so everyone can understand this. If Scott buys a house today at $100,000 and he's collecting $1,000 a month in rent, which is very typical for the $100,000 range in this market, then in 3 years, 5 years, 10 years, I could justify, as someone who's trying to buy a house at that time, I could justify paying Scott a lot more money for his house than he paid, because even if I bought it at $150,000 3 years from now, my mortgage payment, even if I finance it under what we call FHA financing, which is first-time homebuyer financing, my mortgage payment's only going to be about 2/3 of what I was paying him in rent, even if I'm paying 50% more than he paid on the property. So that's the second measure of affordability we're looking for, is how affordable is housing? What is the after-tax mortgage payment on a house if you owned it compared to if you were renting the house? And Atlanta, more than any other market in the United States, has the highest rents compared to what the mortgage payments are on those properties. In our case, in the market that we're in, the sub-niches that we play in, you see mortgage payments that are about half of what the tenants are paying in rent right now. So that means growth potential for our investors.
Just a quick one, John. Sorry to butt in there, but I mean the obvious question, and I'm surprised no one else has asked it, but I mean if it's costing you half to get a mortgage than it is to rent, why isn't everyone running on buying houses?
That's a good question. It's because financing restrictions are so tight right now. And I'm glad you asked the question because this plays into the opportunity. Two things are happening right now at a very rapid pace in the country that's going to point to growth and appreciation for our investors. Number one is supply is being absorbed so fast in the landlord price property sector because you have so much Wall Street institutional money coming into our markets right now, like you had mentioned before, crowding the courthouse steps. We're competing with them when we're buying bank-owned properties now. Multiple offers have to come in. Properties aren't lasting on the market very long. So the one thing that's happening is inventory is being absorbed, and there's not much inventory being added because builders can't compete. When a builder builds a new house to add to the supply that we have right now, they can't sell the property for anything less than $80 to $90 a square foot because by the time you pay for the land, you've done all your horizontal infrastructure, your roads, your water, your power, your street lights, your sidewalks. Then you have to pay for labor and material costs to erect the house. And then you've got to pay for your sales commissions and your closing costs and your resale costs. And then you also have to build in your profit on top of that. The builders can't deliver a house for less than $80, $90 a square foot in the South. So if you have a lot of resale inventory out there at $40 to $60 a square foot, which is what our investors are paying for properties for, then builders wouldn't dare put up a house. And we're going to talk about this in a second, but when you do see builders starting to go to the counties to get permits to build, we call that a housing start. And there's measurements out there you can see what the housing starts are doing. We're going to talk about that in Atlanta. When you see housing starts, builders going to the county to get permits to build houses, that means that the gap is closing between the resale prices and what builders are delivering houses for. And so we're starting to see that climb now, which is evidencing that the prices are starting to go up, among other things, and we'll talk about absorption in a second too. So the first thing that's happening that's pointing to growth is absorption of inventory. The second thing that's happening is, like I mentioned before, the Federal Reserve is running out of bullets to stimulate our economy. They can't make the interest rates go any lower. The public does not like them, conservative public does not like them creating money out of thin air to feed the economy. And so quantitative easing is coming down. So the last thing they can do in our market, if you know how our market runs, the economy is stimulated when banks offer financing. and give loans out there and make loans more readily available. So in 2000, from 2003 to 2006, they were ultra liberal, too liberal with their loan standards. Now they're on the other end of the spectrum, way too tight with their loan standards. You're starting to see sentiment of senior banking officials loosening their lending restrictions or their underwriting guidelines so people can buy houses. The government wants people to be able to buy houses and get loans for houses. So there's more pressure on them to do that, and we're starting to see changes in loan terms already. So as inventory is absorbed, and going back to your initial question, how come people aren't buying houses? Because financing restrictions are too tight right now, so they're forced to rent. But when those restrictions start loosening, and you start seeing people go from the rental camp to the own camp, then you're going to see a spike in price increases, and that's the opportunity as far as from a growth perspective. Does that answer your question?
No, very much so. Yeah, 100%. I mean, look, the short answer, from what I understand, is that it's just virtually impossible to get a mortgage, and so even when the opportunity is there, they can't get a mortgage. They can't afford to go in and renovate the property. You know, they can't put down a deposit. So, you know, renting is the only option, even if they want to buy.
Yeah, absolutely, absolutely. And one thing to note is 90% of properties today that are bought in this price tier, what I call the cash flow price tier for landlords, 90% of those properties that are bought by an end user, I'm not talking about the ones that investors are buying with cash, the ones that are bought by end users that are getting financing, 90% of those are FHA home loans, which is what we call first-time homebuyer financing, where they can borrow 96.5% of the purchase price. Well, until those specifically become more readily available and easier to get for these renters, then we're going to see the prices kind of hold steady outside of the fact that they're being absorbed so quickly. So that's actually what we're waiting on, and that's when we're going to see critical mass on appreciation.
Cool.
Next slide. We already talked about this one. This just shows you rankings across the country on affordability by measurement of what the home prices are compared to what the incomes are in that location, and then also what the mortgage payments are on a property, basically the cost of ownership is compared to the cost of rent. And Atlanta always ranks up at the top. Again, the only two markets that are ahead of us are the car industry markets, what we call the steel markets up in the north. Next slide. So this is a really interesting slide, and if you have a paper and pen, this is something you definitely want to write down, because more than any other measurement, this is visible, verifiable, concrete tactic that you can use to know 100% whether a market, the prices are going up or down. Here's where national media contradicts what's happening on the ground in the market where you're playing, where we're playing. When you want to know if prices are going up or on the rise, whether we've hit bottom or not with the type of product you're looking at, and remember, one type of property has a different personality in the same market than another type of property. Your luxury homes, to oversimplify here, what you see on the screen is you have luxury homes on the right, you have your middle income, the upper middle income homes in the middle, and then you have what we call high impact entry level homes or cash flow type properties on the left there. And we only deal with the cash flow type properties. So if you took an aggregate of what's happening in the market, and that would be kind of a thumbnail sketch of what the media reports across the country, then you know that the luxury homes and the middle income homes, the upper middle income homes, those type of properties they're still trying to find the bottom. It's a very soft market. It's not competitive at all. There's a lot more supply. Well, when you look at landlord price properties, the absorption rate is unreal right now because you have so much institutional money buying those specifically type of properties. And the fastest way to measure absorption is simply it's kind of like if you had a store and you were selling widgets in your store. If you had 100 widgets on the shelf and you were selling 20 widgets per month as an average sales pace, then that would mean if you didn't add any more to your shelves, you'd go through all of that inventory in 5 months. So you'd have a 5-month absorption rate. Now in the U.S., and in most markets actually across the world, if you have less than 5 months of supply, that means you have a seller's controlled market. You have buyers that are putting multiple offers in on properties. You have properties, the days on market are compressing, and you're starting to see properties sell for more money than even they're listed for. That's when the prices are trending up. That's a seller's controlled market, less than 5 months of supply. If you have more than about 6 months of supply, then you're going to be in what's called a buyer's market. We had been on a whole across the country in a buyer's market from the 2008-ish, 2009. The peak of the inventory was about 2011. And in some markets we're way beyond that right now, and it's too late to get the properties at those kind of discounts anymore. So we're starting to see that happening in Atlanta right now. But the absorption rate in Atlanta, to kind of give you an idea what's happening, about a year ago, if you looked at the history of the Atlanta market, it was one of the biggest price losers in the country with the biggest price drops year over year at the end of probably about 8 months to a year ago. Then we turned a corner, interestingly, around February timeframe. It almost happened like a brick wall as soon as Warren Buffett went on TV and talked about buying 200,000 single-family homes, and this flood of institutional money started hitting the markets. The entry-level homes, we used to have about 14 months of supply, 14, 15 months of supply. Now, I just checked, and this is literally, Scott, 2 weeks ago. We went on the multiple list service, the database of properties on our market, and we put in our search criteria for what we look for. Your bread and butter houses that are great for cash flow, 3-bedroom minimum, 2-bath minimum, in the 9 counties that we buy these properties in that are great for cash flow and are safe markets. They have better school districts and so forth. And that, the total inventory came out to be 641 homes. That's what was available at that specific time. Now, in the last 6 months, there have been about 2,800 sales, which breaks down to about 450 sales per month, somewhere around there. So that means that at 450 sales per month, if there's only 640 properties on the market, we got about a month and a half of supply on the market right now. A complete turnaround from what we had about a year and a half ago, and that's what's making us pull our hair out a little bit, makes our jobs extremely tough on the ground. But the good news is for investors, if you can get one of those properties now, you're at the beginning of this tidal wave of price increases. And again, builders aren't adding more supply to the market as fast as these properties are being adored. So that's why we kind of like that area. So if you can know, number one, how much inventory is on the market for exactly what you're looking for, and then you look at the sales pace on a monthly basis over the last 3 to 6 months, that will give you an idea how much supply you have. And if you have less than 5 months of supply, that means the prices are going up. That's the bottom line. Next slide. This is just a slide that we pulled back in February. We saw the very beginning of it. Atlanta was the #1 market in the country as far as the inventory change. 6% of the inventory went in 1 week, and we saw an increase in prices of about 6%. That was the very beginning of what we're starting to see as kind of the end of this opportunity coming. So this window is closing very quickly. Next slide. Okay, this is a really interesting, this graph says a lot. And this is something that we assembled from just our time being in the market for so long, exploring different pockets of the market. Where do we get the best cash flow for the least amount of risk and the least amount of headache from our property managers or from those type of tenants? And so we're looking in neighborhoods where we see high owner occupancy rates, but we were trying to pin down where do we have what price range should we be playing in? And here's this graph pretty much says it all. So if you look at properties that are priced over about 120, 130,000, you start to see rents not climb proportionately as fast as those prices. So your returns start to drop pretty drastically after about the 120, 130,000 price range. On the other side of that spectrum, if you go to properties that are below $70,000 to $60,000 in price, then you start to see higher risk, more transitional tenants. You're in neighborhoods with higher rental saturation versus owner occupants, and they're more transitional neighborhoods with very little to no growth potential. But on paper, and here's a caveat, if you're an international investor, I had an investor from the UK who purchased a $50,000 home against my advice. He was strictly making his decision based on how the house looked in a picture, because it was a pretty cute house. It was a 3-bedroom, 1.5 bath. It was built about 30 years ago in the Atlanta market. and it was another agent offering that house. He bought it because he could buy it for $50,000. The alternatives I was proposing and suggesting him buy were about $80,000 to $90,000 for the same type of looking property, but they were a little bit newer than his. So he buys this house for $50,000 because on paper, after all his expenses are paid, he sees that he's going to be netting at the end of the year 15% on his money. In that case, on this house, that's about $7,500 net that he's keeping in his pocket at the end of the year after all his expenses. But that's the paper return. So he was chasing a paper return and a low price, the wrong way to buy. 6 months later, I get a phone call from him, and he's asking me to visit the house because he's saying that he got a bill from his property manager. It was a $3,000 bill because he says the tenant had left and they didn't fulfill their one-year lease, and now they had damage on the house that he has to pay for to get it rented again. So now, think about this for a second. If you're collecting $800 a month and there's 2 months you're not getting, because that's the vacancy he was left with, that's $1,600 that you take from the bottom line. You add to that the $3,000 renovation costs, that's $4,600 right off of his bottom line. That means that $4,600 on a $50,000 investment is almost 10% on your money. So instead of getting a 15% return on his cash, which is what he saw on paper when he bought the house, he actually net a 5% return on his cash. And then he had to deal with all these headaches. So we just said, you know what, why play in the high-risk area, the high transitional area where you have rental-saturated neighborhoods and no growth potential, when we can play between $70,000 and $120,000, that's the sweet spot where you get the maximum returns. You're in owner-occupied neighborhoods where people take care of their houses. They have pride. You can see it in their lawn decorations, the way they maintain their landscaping and so forth. Their cars are nicer. They think like owners. They don't think as transitional like renters. So you have more growth potential and you have higher cash flows. So we stay the sweet spot again, 70 to about 120,000. That's where you get very healthy, low double-digit returns between 9 and about 11% return on your money, and the least amount of calls from a property manager. And because we cater to international investors that need a passive ownership experience, we can't risk buying the lower-end properties that, even though on paper they show higher returns, they're going to mean more hassles for us and for the investor later.
Just to clarify there, John, are you talking net or gross returns?
That's net returns after you pay your property management fee, after your property taxes, your insurance, and then in some cases your homeowner's insurance, which is your homeowner's association fee, which is very small. So those are net numbers. I always talk net numbers.
Cool. Can I go?
Okay, next slide. So at the beginning of the presentation, I had mentioned that the due diligence is half on the property, the other half is on the people on the ground. And being in the business for 17 years, I know how to ask the questions that will reveal whether or not a property manager knows what they're doing or not, or if somebody is rehabbing the property with the intent to just sell it, wipe their hands of it, and just be done with it because it's someone else's problem now, or if somebody has a long-term time perspective about a property. And so let me just preface all of this by saying that the investors that have been buying in Atlanta with these teams have been coming back to buy more. It's actually something I've never seen before, and it's probably the biggest testament that the people on the ground are doing their jobs well, is when you have 50% of the buyers that are buying in this market now are past investors that have already bought 1 or 2 properties and they're coming back to add more to their portfolios from this same team. That's probably a bigger testament than anything else I've ever seen about a team that does their job, because these are investors who have bought the property, in most cases never seen the property, it's sight unseen. They kind of put their toes in the water, started with 1 or 2, and then 3 to 5 months later, after they've seen that, hey, you know what, the rehab job was done like they said it was going to be. I've got the videos on the rehab. The home inspection came in very clean, and they fixed everything. If there was any items that did come up, they saw that the home warranty they actually fulfilled if something happened with the property that surprised us as far as maintenance goes. In the first 12 months, they offer a home warranty and they actually cover it. And then they've also worked with the property manager, who is literally your informal partner on the ground, who is protecting your asset for you and monetizing it for you and getting good tenants in there. They've worked with them firsthand. They've seen the income and expense statements that they get every month, and they've received rent checks. So they come back and buy more. So that's the experience they're providing. So before I even go into this, I'd just like to say that, because that, more than anything that I would tell you about this or any questions I would ask them, reveals that they're doing a good job, better than even my scrutiny. So the property manager on the ground is National ERA Servicing. The person at the helm of that company is Anthony Salmeri. He is a very creative, experienced property manager, and he does things that evidence somebody who has dealt with, I mean, let's face it, tenants can sometimes be pretty sly and sneaky, and everybody can look good one time, but if you know how to kind of pull back the curtain a little bit to really see what's going on behind the curtain, that's what Anthony's very good at. So here's why I like them. Number one, they offer an eviction guarantee. An eviction guarantee essentially says that if they place a tenant into the property that doesn't pay their rents in the first 12 months, then the property manager will absorb the cost himself of the eviction to get them out of the property, the legal fees and the admin fees. That's not something the landlord has to absorb. So the eviction guarantee is something that they offer. The other thing they offer is, if you go to the next slide here, they do things that are very creative, like a spot inspection or a surprise visit with the tenant that they're screening. So all of your property managers will claim to do these 5 checks. They'll do the employment verification, a credit check. They'll check the court records for evictions. They'll make sure that no adults on the lease have any violent felonies in their past. And then they also do reference checks with previous landlords. This property manager will do all of that, but then after all those checks, he actually shows up at their house, their existing house, before they move into your home, and he'll just take a subjective look at the way they maintain their car. He'll look at the grass. He'll see if there's 5 dogs running in the backyard, if there's trash everywhere. And literally, his most recent story that he shared with me was a tenant that did the employment verification, very nice couple, it was a young family, and their credit check came in good, no evictions in the past, their reference checks came in okay, and then he comes to do this visit. He shows up at the house. The landscaping, the grass is overgrown. The car's a mess on the inside of the car. The garage door is open. There's piles of trash bags in the garage. And inside the hallway of the house, there was a couple bicycles. So their kids were basically parking their bicycles inside the house on the carpeting. And so he canceled their application, and they couldn't get into that house. So there was a lot of time and effort spent in placing tenants, but if you do the job and you put the time in the front side, it's so much less work for everybody involved, including us, on the back side. So he does really look at things from a long-term time perspective.
2 quick questions here, John. Mark has asked, firstly, what does the eviction cost on the average in America?
On the average, it will change depending on the state that you're in. So you have some states that are more conservative, and then you have some states that are more tenant-friendly or renter-friendly. And to answer the question very directly and short, it costs anywhere from $600 to $800 to evict a tenant in the state of Georgia. In other states, it might be more. It takes, on average, about 2 to 3 weeks to get the tenant out of your house in Georgia, which is something that we really like, because it's a very landlord-friendly state. So to answer your question, $600 to $800 to get the tenant out, and if we have to do that in the first 12 months because the tenant didn't pay their rent and we placed a bad tenant, they'll absorb the cost.
Okay, fantastic. And then the other question you asked was, it's all good and well to do a surprise visit if they live in the area, but what happens if they're from out of town?
Then you can't do the surprise visit. You just do it when you can.
Cool. Do you want me to move on?
Yeah, and you know what? To piggyback on that question, it was a really good question. The other question we get is, how long does it take to place a tenant? The property manager has 250 properties under management right now for all of our investors. They only manage the properties for our specific investors. They don't do anybody else. So if somebody came in off the street from New York, for example, who just bought a house in Atlanta and found our property manager, which he couldn't do unless he called in on one of our signs somewhere, the property manager wouldn't take their house because he has a very specific arrangement and he only likes to work with our properties because, again, they're in owner-occupied neighborhoods. They're specifically set up so that our investors can have somebody in the house that protects their house, because we do 3-year leases, not 1-year leases, which means that your turnover costs are reduced 2 to 3 times. You don't have somebody leaving the house every 12 months potentially causing you to have to go in and freshen carpet and paint and so forth. So the tenants have to commit for at least 3 years, and then they're due a lease option, which means that at the end of their 3-year lease, they have the option to buy the house for roughly 50% more than our investors paid for it. Now, if financing is not readily available at that time, they can't qualify, or they cannot, or the property values don't appraise at that time because they haven't gone up 50%, then they won't buy the house from you. So I always explain to investors that the reason for the lease option is not so much as an automatic exit strategy for you where you make 50% of your money. It's really to get somebody in the house who thinks like an owner, not like a renter. So that pretty much addresses that. And let's
can I just back that up, John? This week on Saturday, one of our clients was buying a property or bought a property already, and they got a call to say the tenant would like to put a $3,000 fence into the property. Would they mind? And I mean, at the end of the day, no tenant in their right mind spends that sort of money. But the tenant doesn't see themselves as a tenant. They see themselves as a homeowner that's bettering their house that they're just going to be buying in the future, which is a much better way, a much better quality type of person that you want looking after your property.
Yeah, exactly. And when you do everything right on the front side, the back side kind of takes care of itself. I call it the driving domino concept, where if you had a row of dominoes, so many times people try to take a myopic or short-term view to fix something, and so they'll knock down a couple dominoes at the very end of the chain, but you still have all these dominoes standing, and then everything's reactive after that point. If you find the driving domino at the very front, you just knock that one down, and everything else follows naturally and automatically. Well, in real estate investing, that driving domino is buying properties in owner-occupied neighborhoods where you have less transitional tenants, and then you have a lease structure in place that attracts owner-minded people. And if you do all that on the front side, then everything else happens automatically as a byproduct of the way you set everything up. And that was what most impressed me when I went to the Atlanta market, is that team recognized that, and they had that long-term time perspective. And that's probably why we have so many investors coming back and reloading with them. So the other thing that they do, which I've seen tested and actually work for our investors, which is very refreshing for me, is that the seller offers a 1-year home warranty. So there are no major maintenance problems or surprises that the investor is going to run into in their first 12 months of ownership, because if something does go wrong, the seller will warrant that and cover it out of their pocket. So you don't have to worry about one of the major systems going out or an AC unit going out on you, because if something goes out, it's going to happen within the first 12 months. And the reason they do that is because they feel very confident about their rehab jobs. They get all their properties inspected before they go into them, and they try to mitigate those surprises on the front side because they don't want those surprises either.
Just a quick question. Mark said, what happens if someone wants to leave within the 3 years?
You really can't do anything with it. If they want to leave, they can leave. You can legally chase them down, but the legal costs would just be too exorbitant. We can put a tenant in there in 4 to 6 weeks, a really good paying tenant. So if they leave, you just count on a 1 to 2 month vacancy and just get someone else in there. That's probably the most sensible way to handle it. You could chase them down, but you're not going to get anything out of it.
Yeah, fair enough. Do you want me to move on?
Yes, please. So let's get into what these properties actually look like and what the income and expenses look like on each one. Now, I'm going to talk about 3 properties here. These all have actually already been purchased by past investors. So these are actually real live properties that investors already own. And these investors don't live in the area. They're from all around the globe. So these 3 properties represent 3 different price points on our price scale, starting on the low side at $74,000. And then on the high side, we'll talk about one that was priced at $111,000 for the investor. And just so that you'll know, if any of these are interested, if any properties like this, once you get down to the point where you're working with Scott and IPS to actually get a property, they will have a more detailed breakdown of the income and expenses that I'm showing here. I'm just kind of giving you a quick snapshot.
To be fair, John, I need to blow your own trumpet there. You get a hell of a lot more. You get pictures, you get a whole photo gallery, you get videos where they've actually been around and videoed the suburb and the property. You get the cash flows, you get maps, you get everything. So this is obviously just a very high-level overview, just to give examples.
Yeah, exactly. Thanks for that. And look, to your point, investors, it's one thing to show a picture of I've seen pictures It's funny. It happened in Detroit, as a matter of fact. I've seen pictures, because I see all the promotions. I'm on all the email distribution lists from everybody out there that does something similar than we do, because I'm always out there looking for other markets and how people are doing their business and how they're setting these up for investors. So one time I got this picture of a property that came in, and it was a beautiful looking, cute little house in Detroit. Stone house, really attractive curb appeal. But in the picture, you could see the house to the left of it and to the right of it, the sides of those houses, and there were boarded up windows. So it's just as important in our videos. You'll notice that when we take a video of a house, not only do you see the front of that house and us walking through the house like a virtual property tour, but you see them start with a 360-degree pan of the whole neighborhood, so you can see the forest as well as the tree. So I'm glad you brought that up. So let's go into them real quick. This property is $74,000, the investor price. The option price for the tenant is $110,000. That's the price they can buy the property for at the end of the 3-year period. Keep in mind that the investor, the way we draw up the lease option and the leases, you have all the control in this scenario. If they miss one payment, for example, you don't have to honor that option price. If the property doesn't appraise, you don't have to honor it. So you're protected in a lot of different ways. It was built in 2007. All of our properties were built within the last 15 years. We try to keep it that way because there's a lot less surprise maintenance issues on newer homes. This is a 3-bedroom, 2-bath, about 1,200 square feet. The rent on it is $850 a month. After you pay all of your expenses, your property taxes, your HOA fees, if there is any, your property management fee, and your insurance bill, you net about $7,000 at the end of the year. So that's just under a 10% return on the cash out of pocket on this house, or a net cash flow of $581 a month. Next one.
Just a quick one. There's a question here. What is the difference between the monthly rent and the net rent? And I was just actually replying to it. But it's like insurance management, as you said, HOA fees, which stands for Homeowners Association. But again, for the purpose of tonight, this is just a high level. I mean, we've got detailed cash flows on every property that is available. But yeah, it's the usual expenses that are involved with property.
Yeah, and one of those expenses is the 10% management fee. So the property manager keeps 10% of whatever's collected. If they don't collect anything, they don't make any money. So they keep 10% of what's collected. You, the investor, you keep 90% of what's left over. And they pay on a quarterly basis. That way they can take care of your bills for you, because as a remote investor, you don't want to have to write the tax bill yourself and all that kind of stuff. They make it really convenient. They pay all those annual bills on your behalf, and then you get an email with the monthly income and expense statement on every single one. So if we go at the price scale, we do an $86,000 property. The option price on this one's $150,000. Built in 2004, a bigger home at about 2,600 square feet. The gross rent is $1,100 a month, which would net you at the end of the year about $13,200. But after we take out all of the expenses and so forth, you net about $10,000 or $840 a month of cash flow on an $86,000 out-of-pocket investment. The next one.
Just two things, sorry, just quickly before we move on there, John. Just for South Africans, we don't know what square feet is. You can divide that by 10 as a rough estimate, so that's about a 260 square meter home. And the other thing that's quite interesting from a replacement value is you're looking at between $92 and $98 per square foot. So just call it 100, to be round numbers to make it really easy. That property, to rebuild that property, would cost $260,000. And you're picking it up at 86, just to put it in perspective. And then Sally Penn has asked, how do you get the seller to give a 1-year warranty? Why would the seller agree, for example, if it's a bank? So what's happening, Sally, is that the guys on the ground, RJ and his team, are actually going in. They're renovating the property to a full standard. That all, it's all included. It's completely transparent. You know what you're getting. But they're providing that warranty on the full renovation, so that you've got that peace of mind in terms of what you're getting. Okay, and Mark's asked 267 feet square, is that plot size or living size? That's under roof size, Mark. So, I mean, these are proper American homes. It's the American dream. I've been inside them. They're big houses. It's a complete thumbsuck. But if you compare an apple to an apple, you're generally getting 30%. The properties are 30% cheaper than what you'll get in South Africa, because that building rate's about 8,000 rand a square meter, to put in perspective, and you're getting double the rent of what you'll get in South Africa.
And
sorry,
if I
John.
can clarify too, if I can clarify too, that 2,600 square feet, like on that last house, is what we call heated square feet. So that doesn't even include the garage space. That's actually what's under air conditioning and heat.
Okay.
And the lot sizes in Atlanta, while we're talking about it, Georgia is a very spread out city. Everyone in the city loves their backyards. They love their space. It's a completely different mindset. And so you don't have a lot of people like in other metropolitan areas who live inside the city. There's very little residential population in the city center. So a lot of our homeowners where we get the good rents are buying properties in your all-American suburbs that are about 30 miles outside of the city center. So we're in suburbs outside of the city center. So let's go up the price scale to something that you would see on the high end, $111,000. And by the way, these prices that you see here were from properties about two to 3 months ago. So the prices are about $5,000 more to maybe even $10,000 more than they were before. So we're starting to see
even more. I mean, to be honest, John, I was looking at properties now. I was there 2 weeks ago that were, you know, really nice properties, but, you know, in good areas, but they were around the 130 mark, to put it in perspective.
Yeah, because the prices are going up now. So we're starting to see that all across the board. So like I said, the window's closing. We don't know if we're going to be in this market. We don't know how much longer we're going to be in the market, but we're having to work twice as hard to get the same amount of properties at the discounts that we were buying before. The purchase price on this one, $111,000, option price $160,000, built in 2002, 5-bedroom, 2.5 bath. This is one of the properties, when you start getting up to these price tier properties, the immediate response we get, and it happens almost every time, as soon as we walk in the front door, you see, first of all, you pull up to a house in a beautiful neighborhood that is sometimes nicer than the neighborhoods we live in. And when the guest comes into the house, or a guest comes into the house, the investor sees it as soon as they walk in the foyer, especially if the wife is present. For some reason, the wives start looking at these and getting emotionally attached a lot of times. They'll express a comment like, I could live in this house. And because they see the trim molding, they see a huge kitchen in these houses, a big island, fireplaces. They're very warm houses. So very nice properties.
Can I back you up there? Can I back you up there, John? And I know we're running out of time, but hopefully this is valuable for people. I mean, we were there. I was there 2 weeks ago, and one of our investors has bought a property there, and we met his tenant. We actually asked her. So it was a 4-bedroom home, and she said, listen, she had seen a house just down the road, and it was a 5-bedroom home, but for the same rent. But the moment she walked in that property with the brand new carpets, they've got a very spongy, beautiful carpets. And you know, the nice kitchen counters and all the fixtures, so the dishwasher and the fridge and everything else. And she said it was a no-brainer. Like, she just wanted it right there and then, basically. And she wouldn't even leave. Her exact words were, she wouldn't leave the house until it was done. You know, and that's just interesting. You know, I gave that feedback back to our clients, our investor that already bought the property. But you know, I think it's just kind of, whether it's me, because I personally could live in most of these properties that I saw. They were really nice, spacious, lovely, well presented. But you know, that's always a good sign for your tenants as well. You know.
Yeah, absolutely. And one of our, I'll tell you another story. It was we had a bus tour here because we have so many investors that love, like friends and relatives of investors who are already in that market that want to go check out their houses or come see their houses. And we went into one property, and the tenant works in a hardware store. So she knows, like, carpet padding. She knows what paint costs. She knows quality paint. She knows the countertop materials. And she commented on how everything was upgraded. And that's part of the reason that we're able to command the highest rents, because we differentiate with the rehabs we do. So we do all those little things to really set the house apart. Number one, to give it an outstanding curb appeal, so people will go into the house. Then, to your point, once they're in the house, they have no problem paying top market rents for these houses, because two things. Number one, the standard of the rehab is done completely differently than what they see on the market. And then number two, being that it's so hard to get financing for homes and they can't get home ownership, which is the American dream, they have light at the end of the tunnel, or they feel like there's hope with the lease option, a rent-to-own scenario. And so by virtue of offering a rent-to-own, then they think, okay, look, I can potentially own this house. That creates an emotional involvement that you can't have with a 12-month lease on a house that they have no potential future with. And so again, we attract the home-minded tenant, the owner-minded tenant, and then we can command the top of the market rents for our investors too.
John,
So,
John, sorry to butt in there. Obviously, I'm very conscious of the time here. We are going to keep going, but for those of you that do need to switch off for any reason, please get hold of me. We've got a full report and all the information. There's also an FAQ which will answer many of the questions that people are asking with regards to the lease option, how it works, the type of properties, the areas, and everything else. And there's one question here that I think is pertinent before we move on as well. And the guys asked, what is the difference between the purchase price and the option price? Well, the purchase price is what I buy it for. So I'm the investor. I buy it for $110,000. But the tenant that moves in, we agree a price before they move in at $160,000. So in 3 years, if the tenant fulfills all the obligations, they have the right to buy that property for $160,000. Now, I asked RJ this 3 months ago, and he said to me, I said, well, how many of them, because he's been doing this 35 years, and he said, no, well, on average, 90% of them probably won't even take up the option. And so it's not a definite exit strategy. But if it is if the guy does buy it, well, it's a great return on investment. But if he doesn't buy it, you've still had a great tenant for 3 years, paying your rents, dealing with your property as a homeowner, et cetera, et cetera. So that's the answer to what is the purchase price versus the option price.
Okay, and so this house built, I'm sure everybody's already read the screen, but 2002, newer property, 5-bedroom, 2.5 bath, 2,700 square feet, $1,400 a month in rent. We see rents on the high end between $1,400 and $1,600 a month. That's for our top tier properties. Net income, right about $1,000 a month. So you buy 5 of those and you've got $5,000 of income every month, month after month, passive. Next slide. We talk about timing a little bit because there are so many investors that don't know what's happening. I wanted to pull, I always try to keep the market information fresh. And again, everything is so local here, so you kind of have to temper what you read in national media. So I try to get down to the local level. Here's what Atlanta is saying. This is an article from June 19th of this year in the Atlanta Business News. The number of new building permits, remember we talked about housing starts as an evidence of market turning for the better as far as prices going up, said that the housing starts were up 4% in June from the month of May. So that's a good sign. Next one. This next article is another more recent article. All these you'll see from, I think April is the furthest back we went, but all relatively new. This was from May 11th of 2012. The homes, as far as jobs went up 27,000 positions in March of 2012. And year over year, if you look at the housing start increases for a whole year, then it was up 38%. So builders are starting to come out of the woodwork to erect new homes, which means things are becoming a little more competitive in that market, which we already knew being on the ground. Next one. You'll see this pattern across the whole country. Rents are rising across the country because renters can't get houses and the supply isn't growing by any means. So the rents are rising and the home prices are starting to rise as well. In Metro Atlanta, one of the things that we like to see is jobless rate going down. We love to see people getting jobs to be able to pay their rents. And the Atlanta market about a year and a half ago was at about an 11% jobless rate. Now it's down at 8.7%. That's of April 26th of this year. Next slide. This is from CNN Money, a very recent one. July 3rd was when this came out. Again, rents are rising while the home prices are starting to inch higher. Now that's another aggregate from across the country. So you're starting to see that even from a national media perspective, and an aggregate of all the inventory out there, this is kind of the trend right now. Next one. Wall Street Journal says the same thing. Rents increases, vacancies are drying up. This is July 5th of 2012. Next one. And this is the one that I find most relevant and really interesting. I was very excited when I saw this. TransUnion is one of our credit bureaus, and that's what property managers will use to check the credit on a tenant. And so they keep all the rental data of rental applications that come in, and they know what's happening on the rental market. And what this shows you on the very left, if you can see it, it says the national average increase on rents, what the average rent across the country went from $829 per month, which is the average rent on everything across the country, at the end of the first quarter of 2011. 1 year later, at the end of the first quarter of 2012, it was $865, so it went up 4.4% across the country. Atlanta had the highest rent increase than any other metro market in the United States at a positive increase of 6.3%. In contrast, you look at Las Vegas at a negative 1% in rent. Phoenix, where I am actually talking to you right now, only went up about 1%. Houston, 1%. Chicago, negative 5%. Denver, negative 8%. In Atlanta, again, positive 6%, more than the national average.
Next.
So that pretty much concludes everything that I have to share. Just to kind of sum everything up, this is the investor that I talked to about 18 months ago, who's super analytical and kind of timid, and I call them the Chicken Little investor. They're out there. They're not taking any action. They're not getting cut and bruised. I mean, you just got to get in the market. I've got a lot of cuts and scrapes. Nothing I've done has been perfect, but the net worth continues to grow because I took those risks. And so we package everything for the national investor. Don't get stuck in a permanent holding pattern where you're just doing research all the time. Look for the economic fundamentals from a macro perspective, and whether it's with our team or some other solution that you have, just do something, because in about 10 years, 5 years from now, when the inventory dries up and the opportunity closes, you will kick yourself if you don't get involved somehow. So to sum everything up, from a macro perspective, 30,000-foot view, we love what we saw on the ground as far as the job stability, the economic base in Atlanta. We saw population growth, a lot of people inside the country moving to that area. And then oh, that was your baby drinking his Heineken bottle?
You weren't supposed to see that, bugger.
That's funny. So anyway, so from a macro perspective down to the micro team that's managing the properties for investors, we see everything actually on the up and up. So it's that's why we're playing in Atlanta. But like I said, more important for the passive investors, you got to have a good team on the ground that's helping protect your asset, that has a good lease structure in place, and that can execute. And it's not just a sales organization. That's what I take pride in most, is piercing the marketing veil to get down to brass tacks. Okay, are these people, where the rubber meets the road, are they actually getting it done for investors? And is there repeat business from past investors? And we've been able to put a checkbox next to all of those things.
To be honest, John, I actually just wanted to, and I didn't actually think to prepare it, but these are just pictures I took with my iPhone. I was there 2 weeks ago. You've spoken a lot about these auctions, and just to put in perspective, this is RJ here. I'd actually arrived, the whole team. It was 7:30 in the morning, and I just wanted to click through some of the pictures here, because the chaos of these auctions is just something unbelievable. You heard him talk about
If I can interrupt, for those people that don't know RJ, you've referenced him a couple times.
Yeah.
He is the head of acquisitions and renovations, and he's I call him manic. It's the one word his wife used to describe him, because he is a fanatic when it comes to attention to detail. I've seen him rip into rehabbers that miss little details in these houses. It's good and it's bad. It's good for the investor. Sometimes it can be frustrating to work with the guy, but he is for dang sure going to make sure the house is done right.
And I mean, just my interest. I mean, one of my business partners, a very wealthy gentleman, just came over. You met him as well, John, and he actually said that John and RJ are two of the nicest people he's met in property. I think he's 56, 57. We've invested millions of dollars in Australia as well, so he's done plenty of international investment. But I just wanted to show you quickly, because these auctions are bloody hilarious. In South Africa, when we go to an auction, we sit in a nice hotel with a big screen, a whole lot of proper information, and also we have the the auctioneer, and everything's run efficiently. This is the auction. When he talks about the steps of the courthouse, there's the courthouse. We're outside here. It's actually me and John. That's John over there actually. And I just took pictures of this. I mean, this was in the morning. Like, one of these guys is the lawyer. Actually, it's that dude there with a hat. Okay. Like, he's not wearing a big yellow jacket. He just arrives and starts talking, okay? And literally, like, at any point, you can have 3 or 4 guys auctioning off houses. It's absolutely unbelievable. And I just wanted to show you, this was a video actually. What's going on here now? Let's cancel that. This here was I got a picture actually of us all standing. Oh, this was it. So now we're standing in the absolute pissing rain, and then the lightning comes, and there's a fight between the lawyers as to whether. So this lady here, she's the auctioneer. Okay, I'm not joking, guys. The ladies, that's the auction. She's the auctioneer, reading under the umbrella, reading that thing. It's flipping lightning going on. Okay, and half the lawyers say no, we've got to go inside the courthouse. Another half say no, we can't, because because the law says we've got to stand outside. This is the type of chaos that you're dealing with basically now. So it's one of those things. To answer your question, Mark, and I think Sully asked the question as well. How are they acquiring these properties? Well, they've got a very sophisticated team. They have every month they're reviewing over 5,000 properties. Okay. The auctions, for some reason, are only on the first Tuesday of every month, and they're in 8 different jurisdictions. So that first picture I showed you, that was in RJ's house. The whole team gets together. There's 8 different teams. There's 8 counties. They go out. But before they do that, they have 6 people driving around looking at properties all month. Then 8 days before the auctions, RJ himself, personally, John's already spoken about it. The thing I love about RJ, he says that he's got ADHD in HD. So that's attention deficit disorder in high definition. And he spends 8 days driving around looking at properties. He literally looks at every single property. And I think it's probably worth me just pulling up another presentation that I did a while back, because I think it would be very valuable for everyone just to see, for those of you who haven't seen it. And I just want to show you very quickly. But if you've got your money on the ground, do you want your money tied behind a kind of MBA student that's going to kind of just walk around and look, etc.? Or do you want your money behind a guy like this? This is actually a picture, and he doesn't like me showing it too much, but this is a picture of him. He always gets inside the property. It's absolutely crucial to get inside that property. John's already mentioned it. You can see stuff on the internet that looks hell of a good, but you need to get in. And this is a picture of him. You think that we're sitting on the side of the road. We're not. We're probably doing 100 miles an hour down the road, but you can see the lists there where his team have worked it out, crossed it out, and then John and I arrived at these auctions, and literally, we had to, there was a whole strategy. We had to find lawyers. We had our prices. We were completely organized. But just to give you some numbers, 5,000 properties. RJ and, personally looked at 308 days prior to the auction, over the 8 days prior to the auction, and they ended up buying 16. And just to show you a quick video here, this was this was actually RJ, if you can see it. But he's determined to get into this house. He's not. He doesn't believe that he's. When investors' money is on the table and what is happening, you've got to be able to actually get inside these properties and not just look at them from the outside. And some people say to me, blah blah. The bottom line is, these are the type of operators. These are the type of people that have been in the game, 35 years, and they know what they're doing. And this is RJ. I said to him, dude, what happens if you can't get in the house? And he said, I'll kick the door down. It's the type of thing I would say facetiously. And until I heard a bloody massive thud, and this was the man going into the property basically. But what's that, John?
Oh, yeah, that was funny. Just to clarify too, auctions is just one way that we acquire properties. So as monstrous as a task as it sounds for us to pick up a few properties each month at the auctions, you have to remember that that's just one of maybe 5 or 6 different channels that we have. We have relationships with local banks and lenders that we take advantage of package deals. Sometimes those packages come with properties that we have no use for, but you got to kind of inherit those along with the rest of the properties we do want. You've also got HUD Homes, Fannie Mae, Freddie Mac, bank-owned listings, short sales. So that's just like one channel, just to clarify.
But the point of what I'm trying to emphasize, John, is the caliber of the team and the due diligence that goes on, and whether it's coming from bank auctions or all the other areas you mentioned. I mean, we've had a lot of problems because as South Africans, when I go on the internet and be able to look, on the internet, it's easy. I can look at what the house, next door sold for, and I can get quite a good idea of value. But there's a massive problem in America at the moment because you've got the banks putting on the bank repo prices, which are much lower, and they actually expect bids to be, they're trying to get as many bids as possible, and they go for highest and best offer, and often the prices are 25, 30% more than what the bank, was originally put on the website. But the problem is those prices get left on the website. Then you've got things called short sales, where I, as a homeowner, owe the bank, $1 million, just for argument's sake, but the value is only $500,000 now. So I put it on the market at 500, but I still have to agree with the bank that it's, they're going to write down the 500,000. So one has to be very, very careful of the information that one can find on the internet, and that's why the quality of your partners is so important. But there was one thing that I just wanted to point out here, John, and again, it comes back to the caliber of the people we're dealing with here, and why I've got such confidence and trust in the team and what they're doing. But I mean, when people look at this house, look at the outside. You could buy this on the internet. It looks bloody lovely. You think you're comparing an apple with an apple, but luckily for us, we've got RJ to make sure we get inside properties. And I mean, look at this absolute chaos. I mean, the guys have destroyed the house. There's rubbish everywhere. They've destroyed the walls. There's
I said they were boys now smoking.
I don't even know what that is. It's a cage. There's bloody food on the floor. The kitchen is destroyed. Anyway, I think you get the point. And the only reason for wanting to just give you an idea of that is to really just endorse with real life stories, because really from my perspective, I've been over there and spent the time with John and RJ and been inside the houses, and one really needs to understand the level of due diligence that's going on, the quality of the team, and most importantly, you need to be careful. You've got to be comparing an apple with an apple. I always say to people, John, you alluded to it earlier, buying a property is the easy part. I tend to say to people, buying the property is 20% of the transaction. Actually managing the purchase process, making sure that it's renovated properly, making sure that you've got a good quality management agent that can look after your asset, well, that's actually about 80% of the whole transaction. And I really like what you said. I would rather buy an average property with a great team than a great property with an average team. John, you there?
Yeah, and I should probably add that as much as I know about real estate, I learned RJ has personally owned 350 properties himself, and he's one of my mentors in the real estate world. So every time I hang out with him, I learn something new about real estate. And so even with the 17 years and the stuff that I've been through, he's one of my personal mentors when it comes to buying real estate. So all of our investors are in really, really good hands. I don't think our investors even know, because a lot of them never met RJ personally, how good they really have it, how fortunate they are to have someone behind the curtain that's protecting them.
I mean, this is a guy that, at one stage owned over 350 properties himself. But, again, John, I am conscious of the time here, and I know that you've got to get on to do your presentation as well. But just very quickly in summary, there's just a couple of concerns that generally people ask. One of them is, I want to go to America, choose the right investment. That's fine. If you want to go to America, but make sure you talk to us before you go. It's a massive place, and you need to be finding the right partners on the ground. It's not about just going over and buying property. It's about finding the right partners. But most of our investors, the due diligence has been done. All the research is provided. I personally have been over there twice in the last 3 months, and we can actually provide you the solution from the comfort of your home in terms of where you are. I'm worried about the management and maintenance of my investment property. It's so far away. Well, hopefully we've covered that in a lot of detail tonight. Anthony and his team, they come at it from a different angle. They think out the box, and they've got a really great solution in terms of the 3-year lease back. What happens if the tenant doesn't pay my rent? How can I afford my mortgage? Well, firstly, you don't have a mortgage. You're buying it cash. But secondly, as John's already alluded to, there's actually a process there to be able to evict the tenant. And something specific that ERA offer is that they can actually do it within the first 12 months as well. How do I get a mortgage, and what happens if interest rates go up? Well, as I said to you, you can't get a mortgage. These are cash purchases. It's very difficult to get finance, but that is actually the opportunity. Because when the banks come into the market and they start lending, every Joe Soap, American and investor is going to come into the market and prices will rise rapidly. What I do suggest, though, is that you set it up, you do what I'm doing, and I'm not going to get into all the details tonight, but where you set up an LLC, you buy the property, you buy it cash, you start to, LLC stands for Limited Liability Company. It's like owning a PTY Limited here. You start to create an entity that is generating income, and my aim is within 6 months to go to the bank, arguably Bank of America or someone, and actually say, hang on, I've got a tradable entity here, it's earning an income, and can I start to gear it? Maybe I only start at 20% loan to value, but I will start, and that's one of the ways, because I mean the rates are ridiculous when you can actually get mortgages, something like 4% with a 30-year fix, John, am I right?
Yeah, exactly. That's typically how they're set up.
If it's so good in America, why is it being sold in South Africa? That's not the case. John didn't come out to me in South Africa. I went to America, and actually, funny enough, I didn't just arrive in America. In 2010, I went over, did my due diligence. I just couldn't find partners on the ground that I trusted. So this time I went about it in a different way. There's a company, a gentleman by the name of Rod Thomas. Him and I have worked together since 2005. We've done about 46 million rands worth of transactions together to British investors. And I've got... He's a CA by background. I really like him. I really trust him, and I know that he looks after his clients. And so when I wanted to go back into America now, because I just felt that the timing was right, I got hold of Rod and I said, listen, Rod, tell me about your numbers. And he said, I've helped 1,100 British people invest into America over the last 6 years. And, we've got good solid yields. We've got, low vacancies. And so when I went on my first trip in April, I didn't just arrive in America and look at the yellow pages. I went on the back of Rod's 6-year due diligence, and I know Rod and John, you guys have done a lot together, and really, there's a huge amount of experience that's come to the table in terms of finding the best of breed partners in terms of where you are. The question a lot of people ask me, why should I do it now? Well, I think, John has gone into that in a huge amount of detail. The market is turning, the ship, I don't think it's left the port, but the ship has definitely started to sail, and unfortunately, the longer you take, the less the opportunity is going to be, and I certainly know that. I've been there twice in the last 3 months, and it has changed already from when I was there in April, and it's one of the reasons why I'm going as fast as I can in terms of my own personal investing to take advantage of the opportunity in terms of where it is. Surely it's cheaper if I deal directly with Americans, or even if I buy in America directly from someone. Well, at the end of the day, as I said to you, you can find stuff on the internet, just like John's example. Sometimes, the real estate agent on the ground will happily, try and sell you something, but you need to be very careful of what you're getting. And at the end of the day, between John and RJ and myself, we provide you with a premier service, and by doing that, a full amount of due diligence is done. All the maintenance and management is taken care of in terms of the refurb and everything else. And one has to compare an apple with an apple. And a question I always ask investors is, what would be the cost of making a mistake? There are lots of companies. How do I choose? Well, if you go on our website or send me an email, we've got the free report on the 6 things you need to know before you invest offshore. We've helped over 2,000 people invest internationally to a value of over 1.6 billion. And just like John said, I don't have a perfect track record. Property is a difficult game. I've made personal mistakes, and from that experience of doing international investment now for a long time and helping a lot of people, we put this report together. So use us, don't use us. Use John, don't use John. But please, whatever you do, read that report, because we don't want you to make mistakes. I do have a video here with Dr. Dolf de Roos talking about why you want to go globally. We don't have time because it's on YouTube, so just do Dr. Dolf de Roos going globally, or I can send you the link afterwards. But the point of the matter is, it's not a South African thing. If you had all your money invested in American property in 2007, you would be feeling like a bit of a chop right now, because the values have halved. So if you've got all your money tied up in South Africa, if you've got all your money tied up in property in South Africa, it's not a wise thing. You need to take advantage of global opportunities. And John spent a lot of time tonight going into the American opportunity, and then even more specifically the Atlanta opportunity. And there are other markets out there. But tonight we focused on Atlanta, and particularly the single-family homes in Atlanta, because they provide the greatest opportunity at the moment in the market, and hopefully John has explained to you why, in terms of both capital growth and rental return in terms of where you are. So I'm not going to go into this in terms of this video, but you can find it. I've explained a bit about ourselves and who we are and what we've done. The most important thing that we do from RPS's perspective is we only do international investment. We're not an estate agent that sells you a house in Constantia and then on the sideline tries to help you buy a house in America or in London. All we do is international investment. We've got offices and partners in the major first world countries. I see no point of taking my money out of South Africa and putting it into Zimbabwe or Cyprus, which is an emerging market with as much risk as South Africa. For me, when I take my money out of South Africa, I want to put it into a first world country where I can buy a first world asset with a first world income. We spend millions on research. I think you can see the amount of money our partners in John spend on research. But I personally have flown over to America twice and have spent now in the region of R250,000 myself in the last 3 months just on going over and actually researching and seeing the best of breed partners. And I honestly believe the greatest opportunity in America right now is because of the quality of the partners on the ground. And then really the IT platform, the experience after sales is, John mentioned it's not just about buying a property, it's about all the stuff that happens after buying the property. And then lastly, just to give you some sort of peace of mind, the only regulatory body internationally for international property is AIPP. It's the Association of International Property Professionals. It's run out of London. It's a bit like our Estate Agents Affairs Board, but I think we can safely say a little bit better. And we were the first South African company to become a member of them back in 2007. It's a regulatory body to help you have accreditation and know what you're getting in terms of international investment. So again, use us, don't use us, but please make sure you look out for that badge in terms of the type of people that you're investing with. And then just lastly, in terms of the next steps, contact us. We've got some fantastic reports that John and his team have helped us put together. We've got Atlanta brochures. That's a lot of the stuff that John has spoken about, all the breakdown, what's happening, why Atlanta, some of the examples in terms of the different types of properties and what is actually happening. Interestingly enough, John, this property at the top here is actually one of the properties that one of our investors has just purchased. So these documents are very new. And then we've also got the FAQ, which is everything that John has been speaking about and will answer a huge amount of your questions. So please send me an email, get hold of me, and I'll put up my contact details now so that you can, oh, that's the wrong one. Just give me 2 seconds here. But basically, you contact us, you set up a meeting, we will help you choose the right property, we will then help you set up a structure, the LLC, the bank account, and the income tax number. It all happens in parallel. We'll help you with your exchange control approval, we'll help you manage the purchase process, including the lawyers, dealing with the seller, and actually inspections of the property before you take ownership, and then ultimately, like John has already spoken, management and maintenance, so that you can sit however many miles away it is, 6,000 or 15,000 kilometers away, and have the peace of mind to know that your property is being looked after. And so I do apologize for running over. My contact details are up there. There's our website with all the information, all the videos are up there. We've actually got a shorter video that John has done, about a 14-minute video on why Atlanta. So I know this is a long webinar. You've got our contact details there if you want to go on iTunes. We've got our app, our blog with all our information, Twitter if you want to follow us, YouTube with all the videos, and then our Facebook page. And John, just while I can see there's a couple of questions here that I just want to bring up, but before I do, I just want to say a huge thanks to yourself for taking the time and coming and answering all the questions from all the clients. It's been absolutely incredibly valuable for all of us, to understand the level of knowledge. But it's not the only thing. If people have questions, get hold of us. And between John and myself and RJ and stuff, we're completely transparent in terms of what is happening. And I want to finish off with a story. And for those of you who want to go, you can. And I will hang around to answer any further questions. We had a client that got hold of me on Wednesday. He was buying a property, and he was quite concerned because he did a Google Earth search, and then he found one of these cheaper properties, as I said, on the internet. And once the distrust sits in, now you must understand there's a client of mine that's already bought in London through me, so there's a lot of trust anyway. Then on Thursday, he had another problem. So each day I was like, look, don't worry about it. I'll find out the answers. I'll get back to you. On Friday, he had another problem. Eventually, I said to the client, I said, listen, you've obviously got concerns. What I suggest you do, speak to RJ directly. And if he can't resolve your problems, then we have a problem. But I'm convinced, based on the integrity of the man, that he'll have a good answer for all your challenges, and challenge him. The client phoned me back on Saturday morning. He said, what a lovely guy. I'm definitely taking that property. I'm really happy. I'm flying over in 2 months. I'm I'm going to go and see him, and we're going to spend time with his family and meet his kids and everything else. And I just said to the client, I said, listen, I want to thank you so much for being honest and telling us about your concerns so that we had the ability to answer your questions. And he said, Scott, I want to thank you for your complete transparency, putting me in contact with RJ. And, you know, the moral of the story is John and I don't have anything to hide. We're here to educate. We're here to help. We're here to teach. All that we really want you to be able to do is take advantage of a great opportunity. But really, you've got to have the knowledge. You've got to have the right partners so that you don't make mistakes. And so on my behalf, I want to thank you, John, so much for being online. I want to thank everyone else for being online. It really has been fascinating and interesting. And John, you know, I know you've got to run to get to your presentation, and we have run over time, but thank you so much. We really appreciate it.
No, thanks for having me tonight. I'm really looking forward to eventually even having one-on-one conversation with some of your investors as well. Thanks for having me.
Fantastic. And just to answer a few questions here, as I said, most of them are answered in that FAQ, so please get hold of me and I'll be able to send it through to you. You can see my email there, scott@ipsinvest.com. But Sally asked, what happens if he doesn't have the money to be able to buy the property? He said, can you get a mortgage and hard money? I know, John, you've been looking at some different options, but on the principle at the moment, the answer is pretty much no. I mean, you need to be able to buy cash. Is that right?
That's correct. We are always trying to find financing, but specifically for international investors, it's not out there. So we don't have any financing right now, but hopefully that changes as time goes on.
Look, what a lot of our investors are doing, one of my good friends has done it as well. I'm personally doing it myself, is I remortgage against assets. So I'm remortgaging against my assets in London and in South Africa, and I'm releasing equity, and I'm then buying the properties in America cash, but I'm well cash flow positive based on the returns that I'm getting in America. So, you know, it's just another option in terms of, you know, getting access to capital against your assets in the local, you know, well, for me it's, you know, out of London and South Africa, but a lot of our clients it's purely out of South Africa in terms of what they're doing. Does that answer your question, Sally? And then lastly, there's just one question here from Sarah, and she said, John, you know, if she was interested, you know, Atlanta's a big place, you know, how does she actually find a good investment property?
Well, the first step is, like you said, to engage in a conversation with you personally and to better understand what she's looking for, what kind of resources she has available to her, so we can narrow the search. And then you will handpick 2 or 3 recommendations for her based on her criteria, and then we can go from there. But it's at this point, the first step she needs to take is the next non-committal step is have a conversation with you, and then we can go from there to help her narrow her focus.
Perfect. And I mean, just to give you, you know, one of the things I also do, and you probably see, I work a lot with John and RJ, and you know, say, look, based on this, what do you suggest, and which areas, and everything else. So I think that's enough for tonight. There are a lot of questions coming through, but we've also got the FAQ document, and I'm very conscious of time. And I know, John, you're missing out on your getting to your presentation there. So I just want to thank everyone for this evening. If you've got any questions, get hold of me directly. Get hold of our team. As you know, in South Africa, we've got people based in all the major cities, and I travel regularly, you know, in terms of around the different cities. Come and meet us face to face, just like John said. Get the confidence. Most importantly, I just want to finish off and say, I've been in property a long time. I got very excited in London between about October 2008 to about June 2009. The developers shat themselves. They were giving away discounts of 40, 50%. But unfortunately, that inventory got taken up very quickly, and the opportunity disappeared very quickly. And one of the reasons that I'm all over this at the moment, both with my personal money from an investment perspective, but also helping our clients, is that I have the exact same gut feel that I've got with London, that the window of opportunity is closing. I'm concerned it's going to close quicker than everyone thinks. But on the counter side, when you can buy property at 40 to 50% of replacement value, so forget what the peaks were of 2007. I'm not interested in that. If it costs $100 a square foot to build it, and I can buy it for $40 to $60, that for me represents massive value. And as John has mentioned, if I've got a partner on the ground that helps me manage and maintain it and make sure that I'm getting a consistent rental income, well, then it's a no-brainer for me. I can hold the investment long term, I can benefit from the yield, and I can take advantage of the capital growth as and when it comes. And from me, that's all I got to say. That's the reason I'm aggressively going in. It's the reason that I am so passionate about America and specifically Atlanta. And the only thing I can really say is that hopefully tonight you've experienced the quality of John and certainly RJ, and you need people like that on the ground to be successful. So thank you very much, everyone. Have a fantastic evening. John, thank you very much.
Thank you. Good night.